All right, in this explainer, we're going to break down the real blueprint for building wealth. We're not just scratching the surface here. We're diving deep into the actual mechanics of how to own and then protect what you build.
Okay, so let's jump right in. When you look at who's actually wealthy, a really interesting pattern emerges. A whopping 75% of them are entrepreneurs. And you know who's missing from that list? High-earning professionals. Now that's not a mistake. It tells you something fundamental about how wealth is really built.
And that brings us to the single most important idea in this entire breakdown. It's not about what you earn, it's about what you own. That's it. The whole game shifts from trading your time for money to having assets that make money for you, whether you're working or not. So to really get a handle on this, we're going to walk through a step-by-step blueprint. We've broken it down into these 5 parts. Think of it as a system where each piece builds on the last, from getting started all the way to protecting what you've built. All right, first up, the ownership mandate. What does it actually mean to shift from thinking about your income to thinking about your assets? Well, it's a total change in how you use your money and your time. The key thing to grasp is that real wealth comes from owning stuff that makes money for you, even when you're not actively working on it. A business is like a system that runs on its own. An investment multiplies your capital. Even a super rare skill can act like an asset. They all create value without you having to punch a clock. But here's the thing. Before you can even start building, you need a solid foundation. You can't play the long game if you're always putting out short-term financial fires. That's phase 1, getting stable. A huge part of getting stable is understanding debt. And experts say there are 2 kinds, and they are worlds apart. You've got productive debt. That's when you borrow money to buy something that's going to make you more money, like a rental property. Then you have destructive debt, which is for, well, stuff, things that lose value. One builds you up, the other tears you down. And just look at this number, 22.8%. That's the average credit card interest rate. It shows you just how much that destructive debt is costing you. It's like trying to swim upstream with an anchor tied to your leg. Getting rid of it isn't just a good idea, it's an absolute must before you can move on. Okay, the other part of your foundation is all about defense. We're talking about an emergency fund. Now, this isn't an investment. It's not supposed to make you rich. Think of it as insurance. It's that cash buffer that stops a surprise car repair from becoming a total financial disaster where you have to sell off your assets at the worst possible time. All right, let's move on to phase 2. Once you've got that solid foundation, you can switch from playing defense to playing offense. This is the fun part, the asset accumulation phase. This is the growth engine of the whole system. So here's a question you might have. Why isn't just saving money in the bank a good long-term plan? It feels safe, right? Well, there's an invisible force that's constantly working against you, making that strategy a loser over the long haul. And that force is inflation. Put simply, it means your money becomes worth less over time. The $100 you save today will buy you less stuff next year, and even less the year after that. So if your money is just sitting in a savings account, you are mathematically guaranteed to be losing purchasing power. So how do you fight back against inflation? You have to own things that grow faster than your money is losing value. And what's really cool about this chart is it shows you how different assets have performed historically. Things like stocks and real estate have not only kept up with inflation, but they've actually outpaced it, making you wealthier in real terms. The whole goal here is to take the money you earn from your job and turn it into a portfolio of these kinds of assets. It doesn't matter if it's through a 401k, an IRA, or buying property directly. The point is to build a machine that's working for you, growing your wealth 24/7 long after you've clocked out for the day. Okay, so once you've actually built up some assets, the game changes. Your biggest risk isn't failing to grow anymore. It's losing what you've already built. Now you have to defend your wealth from 2 main threats, taxes and liability.
To get into some of the more advanced tax strategies, you first have to understand a really specific rule in the tax code. It's called the passive activity loss rule. And basically, it splits your financial world into two separate buckets that aren't allowed to mix. Yeah, think of it like a firewall. On one side, you have your active income, the money you make from your job. On the other side, you have passive losses, like the paper losses you get from a rental property through depreciation. For most people, that wall is solid. You can't use those real estate losses to lower the taxes you pay on your main income. But there's a loophole, a very specific exception that lets you punch a hole right through that firewall. If you operate your property as a short-term rental, think Airbnb, and you meet some specific requirements about how involved you are, you can actually change the classification of that activity from passive to active. And once you do that, you unlock this really powerful four-step process. First, you qualify as active with your short-term rental. Second, you get something called a cost segregation study, which lets you write off parts of the building way faster. Third, this gives you huge deductions right away. And fourth, this is the magic part, because it's now an active loss, you can use it to directly lower your taxable income from your main job. It's a huge tax shield. So, wrapping this all up, the key takeaway is that these aren't just a bunch of random tips. Phase 1, Phase 2, Phase 3, they're all designed to work together as one single integrated system for building and protecting your wealth. And this T formation is a perfect picture of what that final system looks like. At the base, you have a trust for your long-term legacy. Then, on one arm, you have LLCs for your active businesses to keep their liability separate. And on the other arm, you have different LLCs that just hold your passive assets. It's all about compartmentalizing everything to protect the whole system. So, we'll leave you with this one final thought. Think of your income as fuel. The real question isn't just about how much fuel you can make, it's about what kind of engine you're building. Because a well-built system doesn't just burn through fuel, it uses that fuel to build momentum that can last for generations to come.